Everyone thinks Japan collapsed in the 90s because of bad luck, demographic decline, or some mysterious lost decade. But that's not what happened. The real story isn't about culture or aging workers. It's about debt, land, and the illusion that asset prices could only ever go up. It was arithmetic dressed up as optimism. In 1991, Japan's housing and stock market bubble didn't just deflate, it snapped like an over-leveraged spring. At the peak, Tokyo's Imperial Palace grounds were worth more than all the real estate in California. Land prices in the city rose by over 300% in just 6 years. Office buildings were flipped like sports cards, and the Nikkei stock index touched nearly 39,000. Today, over 30 years later, it still hasn't fully recovered in real terms. People called it a miracle economy. What they didn't realize was that it was being propped up by a credit mechanism so fragile that once it reversed, an entire generation's wealth disappeared. Without a war, without a revolution, just vanished. And here's the uncomfortable part. The exact same structure, the same tempo of growth, the same blind faith in housing, the same entanglement between banks, land prices, and national pride, is now embedded deep in the US economy. If you've been told that house prices can't fall because there's not enough supply, or because everyone wants to own, or because this time is different, you're hearing echoes of 1980s Tokyo. They said the same things. They even said it louder near the top, but the numbers don't lie. By 1990, Japanese land value was over 4 times the country's GDP. Today in America, residential real estate is nearing $45 trillion compared to a GDP of $28 trillion. And most of that value is concentrated in places where median incomes can no longer support median homes. The difference? Japan hit the wall in 1991. The US hasn't hit it yet, but the wall is there. We're not watching a different story. We're watching the same movie, just in English this time. And that's the paradox. The more you believe prices can't fall, the more the system depends on that belief. Until one day, something snaps, not in public opinion, but in the math underneath. It didn't start with greed, it started with strategy. In the aftermath of World War II, Japan was a smoldering ruin. Cities bombed flat, factories destroyed, a national psyche shattered. But the Americans, instead of punishing Japan like they had punished Germany after World War I, made a different calculation. Rebuild it. Rebuild it fast, as a capitalist fortress against communism in Asia. By 1949, the US was pouring aid, technology, and training into Japan's economy. Not out of charity, but cold geopolitical logic. A strong Japan could counterbalance China, contain the Soviet sphere, and provide a loyal industrial base under American influence. This gave birth to the Japanese economic machine. Not free market capitalism as we imagine it in the West, but something closer to a guided economy, almost feudal in its hierarchy. Government ministries, banks, and corporations fused into one organism. The Ministry of Finance set the tone. The Bank of Japan carried out monetary policy to serve national industry. And commercial banks? They weren't just lenders, they were extensions of the state's will. It worked. From the 1950s through the 1980s, Japan grew faster than any other major economy. Steel, cars, electronics, entire sectors rose like skyscrapers, funded by directed credit, protected trade, and a culture of corporate loyalty. The yen was kept artificially weak to boost exports. Land was scarce, but growth was mandatory, so land became sacred. More than property, it became collateral. Here's where the system quietly changed shape. Japanese banks couldn't create money out of thin air, but they could do something close. They issued loans based on the value of land as collateral. And as land prices rose, banks could justify larger loans, which allowed people and companies to buy more land, which pushed land prices up, which allowed even more lending. It was a feedback loop. Land inflated loans, and loans inflated land. On paper, everyone got richer. No new factories needed to be built, no new technologies required, just refinancing and reassessing. The bubble wasn't speculative in the Wall Street sense. It was structural, institutionalized, polite, and quiet. The Bank of Japan kept interest rates low throughout the 1980s, fearing that tightening would slow growth. Meanwhile, companies used their rising asset values to borrow more, invest more, buy more stock. By 1989, something surreal had happened. Real estate in Tokyo's prime districts was priced over $200,000 per square meter. That's not a typo. It meant that an average office floor could be worth more than the operating revenue of the company inside it. Stocks, too, weren't valued based on future earnings. They were valued based on the value of the land that company owned. A new religion had taken root, the religion of asset-backed confidence. But here's the hidden gear turning the whole machine. The government allowed and even encouraged this system because it created the illusion of growth without having to produce more. If land goes up and everyone borrows more and the stock market rises, then pension funds, banks, and ministries all look brilliant. Political pressure fades, export surpluses grow, and the world applauds your miracle. But it wasn't a miracle. It was leverage. This is the key to understanding what came next and what's coming now. In both Japan then and the US now, the economic model silently migrated from industrial productivity to asset price inflation. In other words, instead of producing more, we valued things higher and based credit creation on those valuations. It feels like growth. It smells like growth, but it's not. It's just the same dollar, valued more on paper. And when the tide goes out, the paper burns faster than steel ever did. It's easy to laugh at a bubble in hindsight, but when you're inside one, it doesn't feel like speculation. It feels like destiny. Japan in the 1980s wasn't full of gamblers. It was full of engineers, bureaucrats, and bankers who truly believed they had cracked the code. And maybe, for a moment, they had. From 1985 to 1990, the Nikkei stock index more than doubled. The total value of all land in Japan exceeded $24 trillion, 4 times the entire US GDP at the time. Tokyo wasn't just a city anymore, it was a vault, a mountain of collateral with its own gravitational pull. Foreign investors were mesmerized. American executives flew to Tokyo just to take notes. Universities held conferences to study the Japanese model. News anchors in New York speculated that Japan might buy out the United States, one skyscraper at a time. And sometimes they did, like when Mitsubishi bought Rockefeller Center in 1989. But here's the twist. The average Japanese citizen didn't feel rich. Wages weren't skyrocketing. Consumption stayed modest. People saved, commuted on crowded trains, and lived in tiny apartments. Yet somehow, everyone around them was getting wealthier on paper. Not from labor, from land. The illusion worked not because people were greedy, but because it was slow, collective, and reinforced by authority. The government said the fundamentals were strong. The banks offered more credit. The central bank kept interest rates low. And the newspapers published headline after headline. Another record for land prices. Nikkei surges again. No sign of slowdown. It was a hypnotic rhythm, and everyone danced to it. Homeowners watched their property values rise by double digits every year. Corporate balance sheets swelled as they reappraised land holdings upward. Banks lent more, knowing the collateral was safe. Even temples and shrines mortgaged their grounds for cash. Why not? Prices only ever went up. A belief took hold. Land is different. They said, there's only so much of it. They said, Japan is an island. They said, population density supports prices. Sound familiar? But underneath it all was leverage, silent, compounding, invisible. Most people didn't know that real estate companies were borrowing at 95% loan-to-value ratios, that even large manufacturers were using their own office buildings to speculate in property, that banks weren't marking collateral down, ever. It was a self-reinforcing game of mirrors. Every transaction confirmed the illusion. Every new high became the new floor. Every person who sat out looked like a fool. In the system, the Ministry of Finance, the Bank of Japan, the commercial lenders, the pension funds, all of them had skin in the game. To question it was to question the entire post-war miracle. And that's the danger of economic religion. Once everyone believes, even the skeptics have to play along. Because if they don't, they're not just missing out, they're out of a job. The music played loudest in 1989. That year, the Nikkei closed at an all-time high of 38,957. It was the end of the Showa era. The emperor died, a new one ascended, and Japan stood at the summit of global economic prestige. More patents than the US, higher savings rates, better infrastructure, a trade surplus that wouldn't quit. But they weren't exporting prosperity anymore. They were importing risk. And the foundation of that risk was this. Almost every financial asset was backed by inflated land prices, and nobody wanted to be the first to admit it. So they kept the game going until they couldn't. If you've ever felt the pressure to get in before it's too late, or watched friends buy homes with money they don't have, know this. That feeling is older than you think. The thing about a bubble is this. It doesn't need a pin. It just needs gravity to return. By 1990, the numbers no longer made sense, and worse, they could no longer be ignored. Land in Tokyo was so expensive that even with generous financing, it took over 100 years of rent income to recover the purchase price of a commercial building. For residential property, middle-class families face prices 20 times their annual income. But everyone said, this is Japan. It's different. It wasn't. The first crack came quietly, from above. In late 1989, the Bank of Japan finally raised interest rates. It wasn't dramatic, just a small hike to curb inflation and speculative excess. But when you're standing on a mountain of leverage, even a gentle breeze feels like a storm. The Nikkei began to fall. First 10%, then 20%. Then it tried to recover and failed. Within 12 months, the index dropped from nearly 39,000 to below 24,000. That's $2 trillion in market value gone. But the real danger wasn't stocks, it was land. See, Japanese banks weren't just holding shares, they were deeply structurally tied to real estate. Loans weren't based on cash flow or earnings, they were based on the assumed value of land. And that value had never been tested on the way down. When the market turned, collateral shrank, but debt remained. And that's when the machine jammed. From 1991 onward, a slow-motion crisis unfolded. Developers defaulted, small businesses whose loans had been secured against inflated property were foreclosed on. Banks tried to sell assets, but prices kept dropping. Worse, they refused to mark their holdings to market, because if they did, they were insolvent. So they didn't. They papered over the hole, rolled over loans, extended maturities. This is when a new term entered the Japanese lexicon. Zombie companies, businesses that couldn't survive without ongoing bank support, but were too large or too embarrassing to let fail. It wasn't just a recession. It was a national face-losing event. Because what had collapsed wasn't just prices. It was credibility. The Ministry of Finance lost control of its narrative. The Bank of Japan hesitated, fearing political backlash. Regulators were caught between acknowledging the truth or preserving appearances. So they chose paralysis. From 1992 to 2002, land prices in Japan fell by over 70% in major cities. Total losses in real estate and equities exceeded $10 trillion. That's more than the entire US GDP at the time. But the most devastating cost wasn't economic, it was temporal. An entire generation lost its future. Young people couldn't afford homes during the boom, and when prices crashed, there were no jobs left. Consumption flatlined. Birth rates fell. Optimism vanished. This was the true meaning of the lost decade. Not just a technical downturn, but a spiritual one. And here's the harshest lesson of all. The crash didn't happen because the system failed. It happened because the system worked exactly as built. Credit based on rising land will expand forever until land stops rising. And when it does, everything built on that foundation turns into quicksand. You can't refinance gravity. You can delay recognition, but you can't repeal arithmetic. That's what broke Japan. And if you look closely, the same math is now building up in the US housing market. City by city, loan by loan, assumption by assumption. If you're hearing this in 2025, know this. The blueprint Japan followed into the abyss didn't vanish. It was filed away, studied, adjusted, and applied elsewhere, just with better PR. That elsewhere is here. And this time, it's wrapped in suburban shingles and 30-year mortgages. The US didn't copy Japan directly. It innovated. Instead of a closed system run by ministries, America built a housing economy powered by securitization, artificially low rates, and the belief that homeownership equals prosperity. After the 2008 crash, everyone said, never again. But what followed was not a return to fundamentals. It was a mutation. From 2009 to 2022, interest rates were kept near zero. Trillions were pumped into the system. Home prices recovered, then exploded. By 2022, the median home price in the US hit $470,000, up from just $175,000 in 2000. That sounds like wealth, but zoom out, and it's leverage. The US housing market isn't just homes, it's debt. $13.7 trillion in mortgage debt. And this time, it wasn't just individuals, it was corporations. Private equity firms like Blackstone and Invitation Homes started buying thousands of single-family homes, not to flip, but to hold and rent. Why? Because with interest rates near zero, homes became bonds. They weren't places to live, they were yield. Rental income became the new coupon payment. Investors didn't care if prices made sense to families, only that yields beat inflation. So housing was financialized. A home became a derivative of future rent streams. Banks packaged loans into mortgage-backed securities. The Fed bought those securities. Everyone got paid, as long as prices kept rising. Sound familiar? It should. Japan did it with land. America did it with homes. But there's a hidden time bomb ticking. After the 2020 pandemic, the US housing market entered a new phase. Supply froze, but prices kept climbing. Why? Because existing homeowners locked in 2 to 3% mortgage rates. They couldn't afford to move and didn't need to. Meanwhile, new buyers faced 7% plus interest rates and record high prices. This created an illusion: low inventory, tight supply, competitive bids. But behind it all, something warped was happening. Affordability collapsed. In 2021, a household needed about 30% of its income to afford a median mortgage. By 2024, that number had reached 44%, the highest since 1985. We're back to Japan's central mistake. Prices are no longer anchored to income, they're anchored to credit conditions. And what happens when those conditions tighten? The cracks appear at the edges. We're already seeing them. Housing starts are down, transactions are frozen, commercial real estate is faltering, offices sit empty, banks are reporting stress, especially the regionals. And homeowners? They're house rich, cash poor, and unable to refinance. But no one wants to say the word crash. Instead, we hear soft terms: correction, plateau, stabilization. The same language Japan used in 1991, the same denial. And behind the scenes, the same mechanisms. The Fed, like the Bank of Japan before it, is caught between inflation and collapse. Raise rates and risk systemic failure. Cut them and reignite the bubble. But here's the truth. The trap is already set. Because once a society uses asset inflation as its growth model, it becomes addicted. To reverse it is politically suicidal. To admit it was a mistake is economically impossible. So the machine grinds forward, slowly, silently, unavoidably. And when it stops, it won't be loud. It'll be still. Jobs won't vanish overnight, but mobility will. Wealth will freeze. And a generation, just like Japan's, will ask, how did this happen if no one did anything wrong? They didn't need to. The structure was enough. No sirens, no headlines, no great crash on a Tuesday. That's how it ends. Not with a bang, but with silence, like Japan in the 90s, like the US is drifting into now. Everyone waits for a moment, a big red button, a collapse you can see. But real economic systems, the kind tied to debt, land, and belief, don't break in one day. They fade. Confidence erodes. Activity slows. People stop moving. Prices don't fall fast, they just don't rise. And that's worse, because nobody reacts. They adapt. A system addicted to rising housing prices doesn't implode. It just stops delivering opportunity. You get fewer first-time buyers, less family formation, more rentals, more concentration of ownership, more wealth on paper, and less in your hands. And still, no one blames the structure. They blame culture, the young, the lazy, the immigrants, the wrong policies, but never the blueprint. Because if they questioned the blueprint, they'd have to admit it was designed to benefit creditors, not workers. Banks, not builders. Central banks, not cities. A system where your house goes up in value only if the next person goes deeper into debt. That is not growth. That is harvesting the future. And when that harvest ends, it's not called a collapse. It's called maturity. Demographics, post-growth, all the terms technocrats love, but it's still the same mechanism. Then in Japan, now in America, tomorrow maybe elsewhere. The names change, the pattern doesn't. So what do? You study the math, you question the narrative, you refuse to build your life on systems that need infinite belief to function. Because when the price of belief becomes unaffordable, the system falls, no matter how sacred it once was. Arithmetic cannot be deceived. If you're the kind of person who doesn't trust headlines, but wants to understand what's really driving the economy, power, and history, this channel was made for you. Here, every episode connects past financial events with today's hidden mechanics, so you can see the system from the inside, not just follow the surface news. Subscribing isn't just about getting updates. It's about building a long-term lens to recognize patterns before they repeat. Because once you understand how power really works, you stop being surprised by crisis and start preparing for what comes next.